So this week we're talking about real estate and high risk investments, and as well as estate planning. So this is a little bit different than what we discussed in previous weeks about the real estate. In previous weeks, we talked about buying a house to live in, making it a home. But this week we're looking at it more from an investment perspective, and and other high risk investments. So let's start with making money in real estate, and let's define what a real estate is. Real estate is a property that consists of land, a structure that's attached to the land, and any accompanying rights and privileges. So, for instance, when I first bought my house I bought it in Walker in Louisiana, and it was my first starter home. And they said, "Would you want to have the mineral rights?" And I really didn't know what it meant, but it found out that it actually meant that when you buy the property with the mineral rights, let's say that they found oil underneath, you actually own it too. So a real estate actually refers to the property that consists of land, the structures attached to that land, and any accompanying rights that go along with that land. Um, the direct ownership of that real estate is holding the actual legal title to that property. So what do we need to do before we invest in real estate? Well, first of all, we need to have some sort of a financing lined up. And again, this is different than the mortgage that we have done in the past. So it may not be as easy, and interest rates may not be as suitable for our needs, and therefore this is a different kind of financing that we need to be prepared for. We need to have our accountants and building inspectors, and we need to have licensed repair personnel. This is very important because if the repair personnel are not licensed or insured, then your building or your new property may not pass inspection, and you may actually end up having to pay for a lot of the mistakes that they do if they're not insured. So there are issues that we need to consider. Again, a little bit different than buying a house to live in. We also have to have some sort of a reserve fund for 3 to 6 months. The more the merrier, obviously, but at least to have a reserve fund to cover the expenses for 3 to 6 months. Your textbook actually talks about a current income and capital gains. The taxes that relate to this, which we're going to talk in a minute, do change from state to state, but there are also federal income taxes that associate with this. But when you're going into this, you need to know your tax situation, and you need to know your price to rent ratio. Think of it like this. In previous weeks, we talked about how you are making an investment in a stock or a bond or an ETF or a mutual fund, and you're paying X amount of dollars, and you're earning some sort of a yield on it. So right now, the U.S. Treasuries at a very short term pay about 1.5% to 2% a year. So if you're buying a house for income purposes, and you're going to rent it for investment purposes, and you're going to rent it, you need to know that without working, you buy a U.S. Treasuries and it pays you 2%. So if your rent to price ratio is anything lower than that, then there's an issue that you need to reconsider. You need to have some sort of a positive cash flow. The price of the house usually goes up, but it's not an absolute must. So the price may actually go down, and especially if there are any foreclosures in the area, if the area that you invested in starts to lose main businesses around, so that people start moving out, then the price of the property may actually go down. But you need to calculate all that expectations into your positive cash flow. The terminology rental yield is the rate of return based on your rent. Obviously, you will have certain expenses, like perhaps hire somebody to do the maintenance, a super. Perhaps you're going to have some sort of insurance that you're going to pay on this property. You're going to have other expenses, and when you deduct all of those from the rental income that you receive, your rental yield will be the rate of return that you receive on the price investment that you made on that property. It's very simple. You could really buy a stock, or buy a bond, an ETF, mutual fund, or real estate, and their returns or rate of returns or yields are comparable. With a stock, you're taking a risk. With a bond, you're taking a different kind of risk. With a real estate, you are taking a completely different kind of risk, but each one has corresponding returns and corresponding risks. So it is just a different kind of investment, and the rental yield is the rate of return on that specific rent. If there is a price appreciation, and that's an if, then you will have capital gains. However, you could have depreciation that's actually tax deductible, and that also could go into the calculations of capital gains. Capital gains are possible only when the property is sold. So you will have to consider the capital gains and associated taxes when you actually sell the property. Obviously, if you have any sort of improvements on the property, then these improvements are tax deductible. So, for instance, if you renew the property, if it was a fixer-upper and you made certain expenses to make the property better, some improvements are directly tax deductible, and they have some tax advantages. For instance, green energy is very, very hip nowadays, and having solar panels or any sort of energy efficient improvements to your property can bring you significant tax savings. Repairs are also tax deductible, especially if you're renting the property, and if you're hiring a super or some sort of personnel to take care of the maintenance, then these are deductible from the rental income. So with respect to taxes, obviously, you are going to pay taxes on this investment income just as you would from buying stocks or bonds or any other investment. However, the depreciation that you have on the property is tax deductible. So this is kind of unique compared to stocks or bonds. A stock or a bond does not depreciate, but a real estate does. Therefore, the depreciation is tax deductible. If you're borrowing to buy this property, to make this investment, then the interest that you are paying on this loan is tax deductible. So in this case, the leverage that you are attaining can increase your return. Leverage refers to simply borrowing. So you have, for instance, say you have $100,000, but you want to invest in a house that's $300,000 so that your rental income could be higher. So your leverage is, for each dollar that you have leveraged two additional dollars, and you will pay, you've leveraged two additional dollars in loans, and you're going to pay interest on this two additional dollars. This interest is tax deductible. So loan to value ratio is your degree of leverage. So for instance, for the example that I just told you, your loan to value or loan to your own equity would be 2-to-1. And capital gains are taxed at low rates, typically 15%. However, different states have different taxations, so tax rates. So this is something you need to check with respect to the state that you live in. So what price do we pay for real estate? Well, obviously, you want to pay the right price, but what is the right price? So your book actually talks about discounted cash flow method, and this actually applies to any sort of investment that you're considering. So for instance, if you're buying a stock, if there's any sort of a dividend payment that you're receiving, what will be the present value of all those dividend payments that you're expecting to receive in the future? If you're buying a bond, then there are coupons. What is the present value of all the coupons and the face value that you're going to receive in the future? What's the present value of all those combined? And what you're paying for it right now should be lower than your expected cash inflow. So the same thing applies to a real estate. You are going to receive a real estate investment. You're going to receive a rent income, and then you're going to deduct all your expenses associated by maintaining the property, taxes and all that. And then whatever income that you have or you expect to receive in the future, you take the present value of that, and the price that you're paying for the house for the investment purposes should be lower than the present value of all those future cash inflows that you expect to receive. So when we say pay the right price, that is what we mean. But so if you're expecting to receive all in all $200,000 in present value of all those future the rent income, minus the maintenance and insurance and the taxes, then the issue becomes, if you're going to end up paying $300,000 for it, then the price is obviously too much. So how do we finance this real estate investment? Well, mortgage rates are usually higher than your own dwelling, meaning if you're buying the house to live in, your mortgage rate will be a little bit lower compared to buying a house for investment purposes. But for investment purposes, seller financing is quite common. So the person or the company who's selling you the property may actually provide financing for you to invest in that real estate. There is a warning. Timesharing can be a financial disaster. There are two types, deeded or non-deeded timesharing. Both of them can be a financial disaster. It is extremely difficult to sell a timeshare contract or to get out of it. Even if you're willing to pay penalties, you still may not be able to get out of it, and you may have to pay whatever fees that you're paying, the co-op fees or any additional fees that are associated with having a timeshare. You may have to pay for it for the rest of your life, and you may leave it to your heirs, and it's just a bad idea all around. And there are so many rental places available, so many, like Airbnb or, Expedia or, other online services where you can actually rent a place. A timesharing contract is a lifetime contract, and you actually leave it to your heirs. And it is, or it can be, quite a big financial disaster. It is something that you want to stay away from. So it's definitely not an investment. So the book probably included that just as a warning so that you wouldn't fall into that scam or to that trap. So it's definitely not an investment. Disadvantages, obviously there are some certain disadvantages of owning a real estate for investment purposes. So for instance, you have a business liquidity or interest rate risk, meaning you could borrow to invest in that real estate at, say, right now, say 4%, and the interest rates could actually go down. So you have an interest rate risk by investing in that mortgage and buying that property. You may not be able to sell the property, or the business may not be as profitable as you thought it would be. The property value may go down. It may be because of the foreclosures. It may be because some of the businesses are moving away. It may be any sorts of reasons, but the property values may go down. And therefore, it would actually make your rental income significantly lower for the futures to come. There could be very high transaction and legal costs. Every time you buy a property like this or you sell a property, you actually will pay a significant transfer costs, transaction costs, closing costs, and legal costs. And therefore, these will add up to your overall cost and lower your expected income from this real estate investment. You may have to pay a lot of initial investment, a large initial investment, and your current income could be quite low. You are taking a mortgage or you are having some sort of financing, yes, but this is an investment property, and therefore it will require you to put down a significant portion of it as a down payment, as a significant portion of that financing has to come from you. And having paid that, you will have some sort of income. However, it can be very low. You have to deal with tenants and unpredictable costs, and things happen. Just because you have a maintenance person doesn't mean that these costs are eliminated. You're immune to this. So if you're renting the property with appliances in it and a fridge breaks down and you need to change it, well, you need to change it, and that's a extra few $1,000s that you have to pay. You also have to make sure that you're dealing with people, and it's not as easy to deal with the ethical concerns, the emotional concerns, and financial concerns. Just to give you an idea, what if you have a tenant and the person gets sick and gets fired and cannot work, and dealing with a serious illness, and he or she is your tenant, and he or she cannot pay. So what are you going to do? To evict the person? From a financial perspective, that's your livelihood and that's your investment return. However, from an ethical and from a humanitarian point of view, it may not be as easy. So, having an investment property may not be for everyone, and it has some repercussions. So those are to be considered. So it may require complex and time-consuming management. There are management companies who actually do this professionally for a living. However, they take a significant portion of your income, and therefore, no pain, no gain. So if you're going to have if you want to have the entire income, the rental income, then you are facing some sort of complex and time-consuming management issues with real estate. The other issue with remember the chapters about real estate and high risk investments, and collectibles, metals, and gems are part of this high risk investment domain. So one of the issues is collectibles, and this is not something that's for everybody. It requires a significant expertise, and it may be very hard to make money. This is an issue, a field in finance all by itself, and it requires significant expertise in the specific field that you're going to buy collectibles. Years ago, a friend of mine gave me a gift of a cartoon. I didn't even know, it actually had any value, but it turns out it was a few $100s, and a decade or so, it would have been at least a few $1,000s. I still have it, and got it appraised, and it was more than $500. To me, it's mind-boggling, but it is what it is. So these collectibles can be quite specific and may require significant expertise. It could take a long time. You buy a painting, and most of the time paintings can go up in value after the painter passes away, and after decades after he or she passes away. So it could take a long time. And it's an unpredictable future. So you really don't know how long it will take and how much you're going to make. So it is a very high risk and very unpredictable investment. That's why we're covering it in high risk investment category. Investing in collectibles over the internet, it's very easy and very convenient, but it may not be always safe. You may be getting counterfeit items. You may be getting items that are they look like collectibles, but they really are not, and so it's not always safe. Collectibles have very low liquidity. It's very hard to sell them at the right price. The bid and ask spreads that we talked about in the previous weeks, the liquidity may be very, very low in collectibles, that you may be stuck with it for a very long time, even though that item may have value. Like, for instance, that the cartoon that I got appraised for $500. I asked the guy who was doing the appraisal and said, "Would you pay $500?" I says, "I'll pay you $50." So talk about low liquidity. There could be very high commissions. So you may not be able to sell this by yourself, and you may have to go to auction houses, and they actually do charge significant commissions. Depending on the type of collectible that you have, it could be as high as 30, 40, and sometimes 50%. But depending on the type of collectible, it can be low too. But what low commission for collectibles is significantly high for liquid finance, financial securities. There are precious stones and metals. So gold, for instance, is very, very common around the world. People have fear about the finances, inflation, financial security, the governments, and all of that. That seems to be, increase the demand for gold and therefore increase the gold prices. But gold is a speculative asset. It has very high volatility, and it really is not, as everybody thinks. The gold keeps going up. It really does not. It has a very high volatility, and just as any other high risk investment, gold is a speculative, high risk investment. How can you invest? Well, you could simply buy bullions, or you could buy coins. The only problem with this is gold is a very soft metal, and as you touch it, it will actually depreciate. You're going to lose, gold smears. So you're going to actually have gold on your hands, and by the time, if you actually keep counting your coins or bullions or keep playing with them, the weight of the gold will eventually go down. So, and also, safekeeping becomes an issue. What are you going to do with all the bullions and the coins of gold that you actually buy? Are you going to keep him under your mattress? Are you going to keep him in a vault? Are you going to keep him in a safe deposit box at a bank? And also, where are you going to buy them? Like, think about it. Like right now, do you know a place that you could buy gold? I bet you that you've seen a van that drives around and says, "We buy gold." I'm sure you've seen one of those. But imagine, at what price would they actually buy the gold? Would it be the price that you have on the actual value of gold, or would the person who's driving that van would buy them at a great discount? So buying and selling a bullion or coins may not be as easy or convenient, and it may involve very high commissions, and it may be very low liquidity. There are gold or gold miner stocks. There are definitely gold mutual funds and gold ETFs. So, for instance, for ETFs, there's GLD is one of the ETFs. I'm not suggesting that you buy it, but just as an example, they have expense ratios, meaning that even if you do not do anything with it, you just buy it and keep it, every year they're going to charge you some sort of a percentage as an expense ratio by holding these assets for you. And when you buy a gold or a precious metal ETF or a mutual fund, they really are exchange traded notes, not really funds. So think of it like they have a vault and they have X amount of gold in it, and they give you a certificate of ownership that represents a percentage of that gold in that vault. So obviously, that maintenance and the keeping and the safety and the insurance, there's certain fees associated with it, and the ETF managers are not in it for charity, so they're going to charge you that expense ratio. There are other, obviously, precious stones and gems and commodities like silver, platinum, rhodium, diamonds and gems, and other that you could actually invest. Very much like buying the actual gems and stones or the commodities, but also buying the associated ETFs with it. Another high-risk investment, you could speculate by trading in the currencies, otherwise known as foreign exchange or FX trading. And there are, penny stocks, which are worth about a penny. And there are always scams associated with it. A stock is worth a penny. How Apple stock is, $200. Well, some stocks are 1 penny. So, people make comments about how, you could buy 1,000 shares and you would pay $10 for it. And imagine if the company goes to $1 million and you'll be a billionaire. Um, so penny stocks are not even dime a dozen. They are single penny stocks. So these are, companies that are significantly distressed. Um, every once in a while, one of these companies will be, uh, revived, if you will, but it may not happen. You may have to invest significant sums. It just, it's a high risk, very, very, very high risk investment. And most of the time, these companies actually file for bankruptcy and disappear. So there are a lot of scams associated with this. People who try to have you invest thousands of dollars into penny stocks, and then you end up owning a significant portion of the company. They don't even trade on a actual time schedule as a stock. They may not even be listed, and it may actually get very, very complicated. So you should be very careful about these high risk investments per se. So these are, I would say, at the very high. I probably would say that if I were to put, uh, I would probably say casinos would go right around there, right before scams, and then right after penny stocks, perhaps. Or perhaps we could even go like this. So think of it like that. So the other high risk investments, and again, your book actually puts these into investment categories, but we talked about this in the previous weeks. Derivatives are actually not investments because they have a short um, period of life. Derivative is the reason they're called derivatives are you're actually not buying a financial security. You are buying a promise to buy or sell a financial security, and therefore there are derivatives. They are derivative instruments. So you don't invest in a promise to buy or sell something. You invest in a stock or a bond or a real estate, or even, in a, silver or gold or precious stones. But you don't invest in derivatives. You buy them, but it's not investing. Options allow you or give you the right to buy or sell an underlying asset at a predetermined price until a predetermined date. They can be options on stocks, on commodities. There can be options on ETFs. There are options on anything and everything that's financially tradable security. Options have expiration dates. They could be daily, they could be weekly, they could be monthly, they could be up to 1 or 2 years. However, they will have an expiration date and they will die. Therefore, when you buy an option, you could lose all your money, all of it. Because if it dies and it doesn't have any value, then whatever you paid for it will be gone. Don't forget, you are paying for a promise. And if the promise is worth this, then your security becomes worthless as well. So you say you had $1 million and you invested, well, not invested, you bought $1 million of options, and then things don't go as expected, well, you will lose that $1 million, all of it. So options are not investments. They are, in a way, betting on an expectation. The strike price refers to the price at which you have the right to buy or sell the underlying asset. Options are created by option writers. Anybody can write an option. So you could buy an option, you could write an option, but when you write it, it's not an option for you. You're obligated to deliver your promise. If you buy it, then you have the choice whether you want to buy or sell the underlying asset. The option premium is the price that you pay for the option. Option holder is the person who's buying the option. There are two types of options, call options and put options. Call options give you the right to buy. Put options give you the right to sell. So options are a way to buy or sell an underlying asset at a predetermined price until a maturity date or the expiration date. A future contract is an obligation to buy or sell a commodity by a set date. So futures and options are very similar, except options give you the right, but not the obligation, to buy or sell an underlying asset until a set date. But a futures is the obligation to buy or sell an underlying asset until at a predetermined price until a set date. So all futures get delivered. So you buy a futures contract for 10,000 barrels of oil. Whoever is holding that futures on the maturity date will have that 10,000 barrels of oil. So economic need creates the future markets. You could speculate in future markets, but don't forget, you are actually buying a significant amount of the underlying asset. So you are buying it ahead of time with futures. Think of it like this. You are a corn producer and you want to sell your corn as soon as you harvest them. Kellogg is a company who needs corn and they want to buy it for their next production line or next production cycle. So they want to go to you, the producer, corn producer, and they want to buy your corn before you harvest it. So you basically agree on a price, agree on a delivery date, and you sign a contract. That is a futures contract. Now, once the delivery date comes, you deliver and Kellogg takes delivery. That's it. We do this over the financial markets, and the contracts are very standardized. Delivery dates are very standardized, and therefore we can trade them on the financial markets, which makes it a normal futures contract. Futures are a zero-sum game, meaning that when you buy and when you buyers and the sellers, one's profit will be equal to the other's loss. So zero-sum game. One loses, one makes money. Loss, profit equals to a zero-sum game. So this concludes our discussion about the high-risk investments, and we'll talk about the estate planning in our next chapter. Thank you.